think a perfect segue is for us to have the issuers introduce their stablecoins and give us a bit of a background of how they got there. So Simon, you want to go first?
Yeah, sure. So ZARP is a stablecoin for the South African rand. We're a member of the Stablecoin Standard, which is a global industry body for stablecoin issuers. As such, we participate globally with a lot of discussions that are happening with issuers, both here in Mexico, in Turkey, in Indonesia. So there really is wide representation for particularly non-USD stablecoins in that group. We're a very proud member. Our treasury is managed by Old Mutual Wealth. We've got a very good institutional relationship with Old Mutual Wealth. And our job is just to be the best stablecoin for the South African rand.
Hi everybody, I'm Uyoyo, and cNGN is a naira stablecoin. Happens to be like first regulated stablecoin in Africa. But before that, we started the first blockchain hub in West Africa, and we're funding like a number of blockchain-related startups and businesses. We also run like a handful of businesses within our group. And then we really just saw the need, to have a stable coin. So we just spent the last, 4 years trying to get through regulation, compliance. And unfortunately, last year we made some progress, and now we've issued cNGN publicly. So
Right,
glad to be here.
All right, so for us just to set context here, what are your respective TVL at the current moment, and what are your flows looking like right now for your respective stablecoins?
Right, so our TVL at the moment is just south of $4 million. Our volumes they're quite volatile, to be honest. It really does vary week by week. We're a DeFi native stablecoin. We're deployed on Ethereum, Solana, on Base. We're multi-chain. We believe that's the only game in town. We don't think that you have a stablecoin unless it's on a public permissionless blockchain. Yeah. So we adopt the same view as industry peers like Tether and Circle and MXN and cNGN and a lot of other players in the market. Those volumes can vary, in the hundreds of thousands of dollars to millions of dollars a day. And I couldn't tell you exactly what the dynamics are that govern that, but it seems to be a lot of arbitrage bots for the most part.
Oh wow, okay, cool. Interesting.
Yeah, very similar. I think we have somewhere around 500K, and so there's on some days there's $1 million, $500,000, $1.5 million somewhere there. But I'm just given that we are in a sensitive space. There's much more demand that we are, I guess, unable to unlock at this time, or just being careful about unlocking, if you like. So yeah, hopefully, over the next few months, as we get more regulatory clarity, in our ecosystem, we kind of see that scale up materially.
Excellent. So I guess for me, the question I have for David on top of this is that there's a lot of questions generally inside of the ecosystem where if you're talking with the American lens, the view is that they are preparing for this dollarized world where the US dollar is now being tokenized and is in some circles being viewed as a tool of national defense. So do you think that local stablecoins need to exist, and why?
Yeah, so I think that's a really good question. And at Honeycoin, I sit also in a privileged position because we've paid our school fees and have been trying to link the traditional financial world with the blockchain world and stablecoin world over the last 5 years. In that time, we've become one of the largest payment stablecoin orchestration platforms. The reason I think local currency stablecoins need to exist is the former CFTC chairman did rightfully say that US dollar stablecoins are the only way to maintain US dollar hegemony, right? Mm-hmm. For them to actually continue to be the primary reserve, most used reserve asset and the largest reserve asset. That being said, what we've done is we've built a tower on one side and a tower on another side, and there's no bridge in between. Because if you have US dollar stablecoins and you're saying that you want these to continue to be permeated across the world, there will need to be players like ourselves who are always doing the hard work of okay, you give me USDC and then I'll give you cash, then I'll need a way to go back into dollars so I can buy that same USDC. Local currency stablecoins to me are exciting, and we are actually investing heavily in building infrastructure to support this, working with the cNGN team very early on and looking forward to also collaborating with the likes of ZARP, because we believe that that is the last bridge to the two towers and two worlds that exist today. We've previously built a business around creating bridges between those two worlds. I don't think we're going away, even with local currency stablecoins existing, because it's like saying when you had FX platforms that exist today, that banks would need to exist and Forex bureaus would need to exist, and the MoneyGrams and Western Unions of this world would be kicked out once we had brought FX into Web 2 platforms. That being said, I think it's a multi-layered problem, multi-layered solution that also needs to be created, whereas you have orchestration platforms like ourselves, you have issuers like the likes of ZAP and cNGN, you need to also have liquidity providers and controversial statement, you also still need to have the banks, right? I don't think the banks are going away anytime soon, and I don't think we should play the role of trying to disintermediate them completely. Because outside of just digital solutions and Web3, Web2, and all of that jargon, there is a world that exists that is grounded by culture, psychological nuances, and the way people like to do things. And those things, the culmination of those things is why I think, number one, local stablecoins will and continue to exist, but we need all of those pieces for them to actually succeed.
I think that makes a lot of sense for me. Anybody else want to chime in before?
Yeah, just kind of add to what David said. I think if you're thinking of this from first principles, right, the way to think of the value of local stablecoins in on and off ramping specifically is it's very easy, very frictionless to go from one rand account to another rand account, right? Versus going from one rand to USD on chain. So going from rand in your bank account to USD on chain, there is no real way to create, for example, a spot order book to kind of get those two things speaking. But you can do rand to rand, right? So rand in your bank account to rand in your stablecoin wallet. And that's one for one. There's little treasury management, no negotiations. You're not dealing with 4 or 5 counterparties in the middle, straightforward. And then going from rand, one stablecoin, right, to another stablecoin. Obviously, the solutions that have existed for like 200 years, right? Like a simple spot order book makes that frictionless and fast. So while it might feel like an additional step, in practice, it's a faster step. It's like going through a highway bridge, like in Nairobi, right? It's an additional thing to do, but it makes your journey much faster and more frictionless. Yeah.
I mean, I would add that for us it's a fairly simple hypothesis. We don't think that local currencies are going anywhere. Fiat currencies are not going anywhere. Sorry, Maxis. We think that crypto is a proven technology. It's also not going away. So sorry to the people who would like it to, but it's not. The whole world is tokenizing. So we really are re-railing the world's financial system using crypto because it's a force multiplier. So if you don't do it, your competitors will and they'll beat you. Like everything's moving on chain. And if all of those things are true, then you have to have a stablecoin for every local currency in the world, right? Because you need corresponding liquidity on chain for all of these instruments that we're tokenizing. If you're tokenizing a money market fund or an equity, doesn't matter what the instrument is, you need corresponding liquidity in a local stablecoin that's available 24/7 on public permissionless blockchains. Otherwise, you're wasting your time with tokenizing. If you're going to tokenize an existing financial product and it's only available during banking hours between 10 and 4, whatever it is, and it moves at the speed of old money, then you're wasting your time tokenizing it. I don't have a problem buying money market funds and equities in the old world using the existing platforms. So if your new tokenized platform works exactly like the existing platform, that's not innovation. You're not making anything better. But if you really do embrace what makes crypto special, 24/7 available, programmable, which is arguably the most important dimension of it, low fees, hyper efficient, like you need that 24/7 corresponding liquidity. So it doesn't matter what way you look at it, anywhere in the capital formation stack. Stablecoins do anything you can do with money, you can do better with stablecoins, and every single currency on earth has to be represented.
Yeah, so that you actually preempted another set of my questions, where we have local currency stablecoins, and I feel as though payments are the first use case, and then you began talking about bringing certain securities on chain, like tokenized money market funds, inside of all of these spaces. So what do you feel would be the next frontier beyond just the payments use case? And especially considering the role of local currency stablecoin as a unit of account inside of different tokenized products that other people may come and innovate around.
I think you're on your roll.
Look, I think payments are arguably quite a tough nut to crack. They're a little bit further down the adoption cycle from our perspective. They're obviously critical because they create the circular economies that we need for local stablecoins to be successful. But merchant adoption, retail adoption, these are all curiously quite difficult problems to solve. You've got massive point of sale infrastructure, for example, that isn't being upgraded anytime soon. And what we'd love to see is native stablecoin payments where you don't need intermediaries. That's kind of the whole point of crypto, right?
Yeah.
But what we're seeing instead is us shoehorning existing payment rails to incorporate stablecoins into them. So it's like we're taking the thing that crypto was designed to disrupt and do away with, and we're injecting it back into the system because
Mind you,
people...
Visa is a sponsor here.
Yeah, cool. But
So I want to come back next year.
yeah, and they're doing good things, and I like the fact that we can settle in stablecoins. So a lot of these players are going to be relevant for the foreseeable future. I'm not disparaging them.
Yeah.
I'm just saying that there's a massive advantage here on the table for merchants who can, save directly to the bottom line if they embrace these technologies the way they were designed to be used. But that's some step away. So I think payments are a little bit further away than the adoption that we're seeing in arbitrage, in remittances. So that really, in the adoption of any financial technology, or actually any technology, it always starts with those who have a means to use it as the first adopters, right? If you go through the dissipation of innovation curve, your early adopters are the people who can afford to use this technology and really leverage it. So right now it's high volume trading, it's arbitrages, it's cross-border remittances, but it's starting to flow up the stack as those volumes increase, and it creates these circular economies for stablecoins. So we're moving towards payments, but that's actually a little bit further away. I don't know if you agree with that sentiment.
Yeah, and maybe just add on that. So agree with Simon completely. And we've been fortunate enough to get investment from Visa, working very closely with the likes of Circle and Tether. And I only mention that to preface that the thing that I've found encouraging is that the old money, traditional issuers, the Visas and MasterCards of this world, are paying attention because they're also seeing where the world is going. Visa card came about because people were frustrated in carrying money around just to pay, right? And then you wanted a more secure way to do things, and then now we're seeing cards. Well, MasterCard and Visa also have plans to have cards that do not have card numbers, right? So the card itself is tokenized, and you can basically just be able to use that as a payment instrument that's linked to your phone. Apple Pay is successful because it also decreases friction a lot more than the existing kind of like technology, which was just that having a physical card. Now, that's a preface basically to say, I do not think that we will see payment utilization to the degree that we should be able to see it unless we solve for the attraction problem to local currency stablecoins. What do I mean by that? US dollar stablecoins were very beneficial and have been beneficial to issuers because they can hold US dollars and US dollar assets, dollar-denominated assets, such as T-bills, government bonds, and the likes. And Tether has benefited significantly from that, right? When you look at institutional money and liquidity, the only way you get payment utilization is if there's money in circulation, right? The work that Zarp and cNGN team have done is incredible because they are actually the fire starter that is supposed to set ablaze the utilization of these local currency stablecoins. But I think we need to start having a conversation and giving incentives to institutional players, liquidity backers, such that we get more money in circulation that is incentivized to stay there for a longer time. Now, this is a two-pronged problem, and this is outside of our payment cases, which is what you asked, because what you're trying to tell this person is you can hold my local asset, and it's beneficial to you for two things, right? You'll get yield by holding a local currency asset and instrument, such as a bond, your government instrument that will generate yield, and so you're like, okay, I'm giving yield on that regard. But then the other problem that we face is most local currencies in the African context are volatile, right? The rand is fairly stable, Kenyan shilling fairly stable, naira not so stable.
I feel some people would.
Naira not so stable, but getting much more stable once it's free floating. But here's the problem it's created. If I do not have an incentive for backing the liquidity that will create the utilization, those incentives have to come from the things that Simon mentioned. Arbitrage, trading, and so on and so forth. I think we need to create more local incentives for local stablecoins to be backed by institutional players, otherwise we'll not get payment utilization. Because the only reason we have successful US dollar and euro stablecoins is because the incentives for people with boring, idle money that just want to basically back this position, and then we wouldn't just have it then as a stablecoin for payments, then we'll actually have liquidity that can be used for everything outside of payments, including on-chain FX that doesn't exist today because we do not have a on-chain FX market for the local currency stablecoins.
So this brings me to, I guess, my second, least spicy question is reserves. So there is, all of you have mentioned the idea of tokenizing these, backing these stablecoins using local debt instruments or something of that sort. The US, I think yesterday, put out legislation where they basically said the short-term securities are the gold standard. Yeah, I think Circle won the battle. So then the question is, if you're looking at like bonds from African markets, they're not AAA, you know? So does it represent like a systemic risk in you essentially having tokenized securities backing domestic securities backing your stablecoin? And what does that range look like in terms of the risk appetite, in terms of if it is you become a sink for just domestic debt?
Okay, so I mean, fundamentally, right, stable coins are only stable relative to the reference asset, right? So all you need to do for your tokens to qualify as a stable coin is to ensure that it's always redeemable one-to-one to the reference asset, right? How sort of holders or investors in those tokens decide to treat their FX management or like currency risk, whatever, I think is a different question. But yeah, fundamentally, I think stablecoins always need to be backed by the reference assets that they are supposed to be tracking. It's just the easiest way. Because anything beyond that, you start to introduce like derivatives.
So you're advocating for fiat backing?
Yeah.
This is any type of stablecoin, right?
100% fiat backing?
Ideally. Whatever the stablecoin is, if your stablecoin is tracking gold, if it's tracking because we're now working on tokenized money market funds with some of like the largest money market funds in Nigeria, and we'll probably have like a $5 million money market fund in Q1 next year, right? But even that, I mean, naira is, on the whole, relatively unstable, right? But one, naira yields are quite reasonable as far as if you consider that you can probably make 20-25% on your naira government debt, right? On most years.
What?
Yeah.
It's really attractive, yeah.
Yeah. And, government has never defaulted on that because it's naira, right? But considering that you can do that, if you really do your computations, you might find that net, you're probably net positive for holding like money market instruments in Nigeria. Because naira doesn't just, contrary to popular belief, it doesn't just go like this, right? The very least is this, right? So at any rate, if you back that token with any instrument other than the reference asset, you introduce like material complexities to your reserve situation.
What do you think, Simon?
Yeah, I mean, I largely agree. Our treasury is very conservative. It's cash equivalents. I absolutely agree that you have to be backed by the reference asset, otherwise you're not a stable coin. So we don't believe in currency baskets. We don't think that coins representing currency baskets are possible or even desirable. I'm a big fan of the experiments that are happening in algorithmic stablecoins, but I don't think that anything's been proven there yet. There really isn't a strategy that's proven that it can scale. So we have a very conservative approach, cash equivalents. I mean, there's some very interesting philosophical discussions to be had about cash in the bank because banks run fractional reserves. So is your stablecoin really 100% collateralized if that money is in the bank? Because the bank doesn't have the money that's backing your stablecoin, not all of it anyway. Depends which country you're in. I think we're also very fortunate in South Africa. We have a relatively stable currency. The price of the rand is artificial because we have anachronistic foreign exchange controls. Yeah. But for better or for worse, it's less volatile than a lot of other emerging market currencies. We live in a high interest rate environment, so treasury management is a lucrative business. And we have pretty robust institutions that we can work with. As I mentioned, we partner with Old Mutual Wealth to manage our treasury reserves. So I think we're quite fortunate in the South African context that the reserve model, which is really widely being adopted by industry. Again, if we look at the other issuing members in the stablecoin standard, we all commit to regular attestation of our treasury reserves. We work with auditors that do on-chain attestation against our reserves. We issue those on our website, fully transparent. I always find it interesting when I see stablecoin issuers that are asked on stages what their TVL is and they can't answer it. And we just go to CoinGecko. It's all on-chain, Yeah. So for us, transparency is paramount. That's why public permissionless blockchain infrastructure is so important. And that's why our TradFi industry peers are flocking to these networks. Where's MasterCard building? Where's Visa building? What is Stripe doing? BlackRock, biggest asset manager in the world. Fidelity, I could carry on. Where are all of these institutions building? They're building on Ethereum, they're building on Solana, they're deploying on Base. They've done their homework. These aren't stupid companies, So if your company's building somewhere else, why? It's a really great question. Why? If you're using, things that just don't make sense, like private permission blockchains, why are you doing that? And if you've got an exotic reserve backing your stablecoin, why? And when you ask why, you do not get good answers to the questions.
100%.
And that's really what separates the wheat from the chaff in terms of true stablecoins versus the clown cars that are operating as stablecoins.
So I have a final, probably most controversial take, where if you're looking at the issues of local currency stablecoins, a lot of regulators have been considering and talking about enshrining the role of a local currency stablecoin in on and off ramping, where that would essentially look like you could use USD stablecoins for whatever you want to use them for, but whenever you're converting to our local currency, we would like you to use one of our existing issuers, assuming there's cNGN, NGNC, so on and so forth. Use any one of them. And the reason why a regulator would look at it like that is that it then gives them sight into what the flows are in a way that if it is I could move from a centralized exchange from US dollars directly to like fiat through an order book or something of that sort, it doesn't really enshrine the role of a local currency stablecoin. So this is an active point of consideration. And I wanted to ask for you, the two of you are issuers. This applies to you differently from David, who is running a wallet, or a OTC desk. What would that kind of enforced or enshrined role mean for you? I don't know if the question is clear.
It looks like we're almost out of time.
Maybe I'll be clicking for you this time.
We have about 5 more minutes. Don't worry, this is a safe space.
Is it?
Nobody's recording.
No, I really agree with everybody. I don't see a future where you have like all USD, right? I just don't see that happening. No less because of what is happening with China right now, right? And China is such a big player in the African space. And China is committed to kind of removing like USDC flows from some of those like Africa-China flows. And a lot of the African flows terminate in China, as you know. A lot of the OTC dealers in Africa are Chinese, right? So yeah, I just don't see any sort of like that happening, too much of that happening, right? But your question on the rules, I think there's always going to be a place for local currency, right, on chain. So right now on and off ramps, you do USDT to local bank accounts, right? Using a local currency stablecoin in that flow obviously gives more visibility, makes it technically easier to do, makes it more transparent, makes it faster, right? So I think that's obviously like a good start. I'm not sure if I got the question exactly right.
No, that's it.
Yeah, but I think that's a good start. But that's definitely not the only role of local currency stablecoins, right? Local currency stablecoins are going to do everything money can do. Because in the end, it comes down to, is your vehicle liquid enough? Is your vehicle priced properly? And is your vehicle accessible enough? Whatever that vehicle is, bank accounts, stablecoins, it doesn't matter what the name is. If it's the most liquid, the best priced, and the easiest thing to access, that vehicle is going to win in whatever vertical it goes into, right? And I think, there's room in interbank switching, there's room in derivatives, there's room in payments, there's room everywhere. It just depends on, one, regulations, and two, the players, how we shape up this ecosystem.
Yeah, I think maybe just to also add to that conversation, I think and start by drawing a parallel to a market like Kenya, right? VASP bill has just come out. There's a category for stablecoin issuers. There's a category for on and off ramps. There's a category for exchanges. The closest thing to a local currency stablecoin in the Kenya context is M-Pesa. M-Pesa is licensed by the central bank as an e-money issuer and also a payment service provider, which means they can issue Kenyan shillings on their app and tell you that this is one-to-one tied to the Kenyan shilling that's within the central bank. I think that there will be multiple local currency stablecoins, even in the Kenyan context. I think it's already there today. There will be multiple NGN stablecoins, there will be multiple ZAR stablecoins. What I think will happen is there will be consolidation, and that consolidation will go towards the local stablecoin issuers, such as the exchanges or on and off ramps, who will say, I want a local currency stablecoin as well, because it will be to the goal of creating just a much more direct channel to point of you want to go from USDT to NGN or USDT to KES. Now, you can give me the USDT and I'll be holding KES domestically, but then I can't actually build a programmatic way to manage that liquidity, right? Local currency stablecoins present an opportunity even for exchanges, even for on and off ramp providers, to basically programmatically manage reserves, manage liquidity, and manage price. And I think that there will be many issues. I don't think there'll be one. And then over time, we were talking about this, Tony, with you just on the side there, the multi-asset issuer model and the single asset issuer model is actually born out of a multi-asset issuer model, where you have a multi-party, issuer model, where you have multiple parties that issue their stablecoins, you have consolidation, and then outside of consolidation, you then start having what we call centralized liquidity, right? You can bridge from USDC to USDT, not because that was how it was programmatically built in the beginning. You can do that today because there's people who like to use USDC, there's others who like to use USDT, right? There's no USDC on Tron, but there is USDT on other chains, right? Those things will not go away, and I think that the incentive for multiple local currency stablecoins is because the approach for multiple players is going to be different. But I think the beauty of how technology works is consolidation is a guarantee. It's not an if, it's not a maybe. It's just who does it well, who are they working with, what are they giving to retail, what are they giving to businesses, and the regulators themselves, I think, will play a much smaller role than we like to think. I think for them it's to create the guardrails and the framework and to improve that framework over time, but it's the players who will actually start to inform what that would look like at scale, both now and leading into the future, would be my take outside looking in from a non-issuer and as a platform and player within the space.
All right, cool. Simon, any last words?
Nothing to add.
Looks like that's our time. Opening up to in case anybody has any questions.
Person, I saw a hand behind. Then we'll go to the gentleman in spec. Somebody else? All right. Do you have a microphone? Here, next to you. So you can ask your question and who it's directed to.
Thank you. My question is directed to the issuers, cNGN and VER. My question is, what are you doing to ensure or build that trust within the consumers or the ecosystem, right? Why people use or hold the likes of USDT or USDC is because of the trust. They have the trust there because of the transparency and their perception about credibility, the reserves, the audit trails, and all that. So for the local issuers, what are you doing to build that trust within the ecosystem?
Thank you. I think I have maybe a slightly controversial take on this. And to the point, let me first preface by saying we do everything. We have auditors, we have attestation auditors, we have financial auditors. Every day they look at the on-chain balances, match it with our bank account balances, assets. In fact, I'm supposed to sign off our audit report for last month. It's just on this trip. I just came in this morning, so I couldn't. So we have all of that. We're regulated by the SEC in Nigeria, so there's this pretty high bar for what we kind of need to do, right? We have custodians where we have to keep our reserve assets with. We have reserve banks. Our auditors have to confirm. We have an internal auditor that has to confirm that the money is in bank before it goes to the approvers. We have 3 approvers, so 3 have to approve. There's a whole process to kind of ensuring that the naira is kept somewhere before you can mint any cNGN in circulation. But to the second part of my response, until recently, right, USDT, Tether may not have been publishing attestation reports or anything like this. This is a relatively new phenomenon, right? And I only make this point to say, when we were using Tether 2017, 2018, it wasn't because we trusted, Bitfinex or Paolo or USDT or anything. It was because USDT is the most, in Nigeria, for example, USDT is probably the most liquid USD, right? If you want to move $1 million, $10 million, it is the easiest, fastest, cheapest way to do it. And primarily, most people using USDT have never ever read a attestation report. They don't even know what the website is, right? The website is even weird. It's something.co. So nobody goes there. I make this point to say trust and brand kind of takes time to build up, right? And that's social recognition. But also, and I think more importantly, is access. The more these tools or these stable coins, the more accessible they are, the more liquid they are, the better price they are, the more likely it is that regular everyday people, institutions, businesses would use them, right? Because it's easy to be convinced that something is legitimate if it saves you money or it makes you money, right? It's much easier to say this. Okay, I trust these guys, right? If they're making you money. So I think that's roughly it. We need to get to a situation where these stable coins are more liquid, better priced, more accessible than the competition or the other technology. And then over time, we already do most of the stuff. It's Bank of International Settlements published something called Project Prix Trial, like 2-3 years ago. So we've implemented most of these things already, right? And we do everything Seku does on the attestation, audit parts. So that those already exist. I think some of these things just kind of take time and viability to prove yourself.
The 3 most important words in crypto: don't trust, verify. This is the whole point of public permissionless blockchains. You don't have to trust us. We cannot hide the information in our ledger. Every single token we have issued, you can go and verify on-chain using a blockchain explorer like Etherscan or SolScan if you're on Solana. Every single transaction that has happened down to the very first minting of ZARP, you can go and verify yourself without speaking to us, without trusting our systems. You can go and verify that information. However, as stablecoin issuers, we are bridging the new permissionless, trustless world of blockchains where transparency is everything with the traditional opaque financial world where ledgers are closed behind doors and you can't go and access them yourself. So how do we solve that problem? We bring in independent auditors. Don't trust us, trust their attestation reports. Our auditors have gone and they've spoken directly to the financial institutions that manage our treasury, and they've verified our balances with those financial institutions. They've done the hard work of going on-chain and verifying that every single token we've issued is backed by cash equivalents with those financial institutions. Our smart contracts, the code that powers ZARP, is published on the blockchain. You can go and look at every line of code yourself. We've brought in smart contract auditors to make sure that there are no security flaws in our smart contract deployments, but those contracts live on-chain. Again, this is the point of public blockchains. You can go and look at this code yourself. So don't trust us. Verify what we're saying. Take the word of our auditors. Look at what's being published on-chain. And if you're looking at a stablecoin project, go and open up an independent data aggregator like CoinGecko or CoinMarketCap and look for that coin. And if you can't find it, there's a transparency problem, there's a trust problem. Our coin is on-chain. We don't control the aggregation of that data and how it's published. We can't hide anything on-chain. That's the whole point of public blockchains, and that's why it's the only game in town.
Next question.
Yeah, question for Simon. So Simon, you are part of or ZARP is part of Stablecoin Standard. Think of it as a consortium of issuers or something. And just as a side, by the way, the previous question asked, stablecoinstandard.com has stable check guide on how you can issue a stablecoin, essentially. It's like 60 or so, things that you need to check just to say you have a stablecoin, local stablecoin. What success stories are you seeing with other non-USD stablecoins? Which projects are you looking at within the consortium and globally that are very successful in executing on the non-USD stablecoin side of things?
Yeah, it's a great question. I think for local stablecoins writ large, it really is very early days. I don't think we realize exactly how early we are in what we're trying to do. I think it's early days for dollar stablecoins as well. I mean, if you look at the market cap of Tether, what is it, $200 billion? That sounds like a lot of money. But if you look at global money markets, that's still a drop in the ocean relatively. So we've got a long way to go. Where we're seeing success stories at the moment, Indonesia has a stablecoin project that's doing very well. Mexico has a stablecoin project that's doing quite well. Canada, interestingly, there's a CAD stablecoin project that's doing very well in the Canadian market. Some of these stablecoin issuers are finding niche usage. For example, in the context of the Turkish lira, there's a successful Turkish lira stablecoin project as well. That's another member of the stablecoin standard. So it really depends on which jurisdiction you're looking at. Some markets, you've got hyperinflation that's driving adoption of stablecoins, and there it's predominantly dollar stablecoins, and the local stablecoin is being used as an on and off ramp predominantly. You've got other markets where remittances are starting to take off. So it really depends which country you're looking at. But what we all agree on is what global best practices look like for stablecoin issuers. And I think the standard is doing a great job of kind of documenting that, building policy teams that can come and speak to local regulators who are unfortunately getting terrible advice from the local counterparts in our industry. But don't get me started. So you know, that's sort of what we're seeing. But I really can't tell you too much substantive about the adoption of any local currency stablecoins because we just don't have that quantitative data yet. It's really very early on in this experiment. And I think we're all still learning.
I think, well, two things I'll add. One, tracker.stride.se. Remember your name again. Yeah, Alex Feeney. So he has a website, tracker.stride.se. I think it's meant to go live today, which has all of the local currency stablecoins across the world. I think we have like 29 or 20-something, last I checked, or something like that. 38 local currency stablecoins. So please check it out. Give him feedback while you're here over the course of the next 2 days. And the only addition to that is, like, for me, from an FX standpoint, having looked at various liquidity pools and looking at what those markets are, it's still really, really early in terms of finding like FX price discovery, especially when you're looking at some of these local currency stablecoins. I think domestic use cases are actually emerging really, really strongly. But then the next frontier, I think, would be looking at the role of